I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Hey, Jim, here we are again.
How are those cryptocurrencies doing in the whole blockchain business?
Oh, man, that's been something else. As it was going on and we were talking about it, the price gains were perhaps the biggest in any bubble, and there have been a number of bubbles, and these things were immense gains. But they're driven by intense emotion, and then that becomes measurable. So we were using like gold on the way to the huge speculative blow-off in 1980, January 1980 as an example. Oh, the Nikkei that peaked in December of 89 was another. So while the price changes were huge, the momentum things were similar on previous. So we took it was October 4th edition, and it looked at all of the markets in the context of a bubble and said that, things, if a market's going to go all to hell, it'll be in September, October, and this was October the 4th, and we looked at things, we were kind of dull a bit and said that the bubble had another leg in it, and it would even bubble the Dow Jones average. So the next step on that was to note that there's been a number of stocks. That's why I mentioned gold and the Nikkei, a number of big speculations that blew out in December, January. So that was a probability. And then with the Bitcoin itself, that on December 19th gave what we call a sequential sell, and the only previous one of those had been 2 years earlier, and it had a big correction. So we noted that it would likely be the biggest correction in 2 years, and it has been. And but at the moment here, there were tag-on stocks came out during the play with the blockchain. Hive is one of them out of Vancouver. The other's Riot. And they had their fun and began a long decay. And they really sold off worse than the Bitcoin itself. But as of these ones, the Riot and the Hive, as of the last couple of days, they're very oversold and giving one of our sequential buys. So this would be for a bounce for traders, very nimble traders only. The big bubble was extraordinary, and when you line it up with the decay of previous bubbles, as I said, such as gold and silver in 1980, there's a certain pattern on the way down. So let's just put it at this, that the two items that were being sold down the hardest are now down to a sequential buy where you could get a bounce for these things. You never know how long a bounce, because the area is so volatile. It could be some weeks. It depends, how the markets go. But it is the whole sector, the Bitcoin thing has been a fabulous bubble. It climaxed and is early stages of a probable contraction. So then, Jim, we go to the next part of the markets, which is the big stock market, the New York Stock Exchange. And again, our idea back in December was that with a peak in the highly speculative side, that, say, the S&P would likely follow, which it did, because that then was in January. And then also with that, there was if you take the whole broad market in New York, the New York Composite, that's the symbol's NYA, it had a peak on the same day as the S&P and has had a considerable correction in this. And with the start of the break, we figure on the senior indexes that they would come down and build a base and then do an intermediate rally. But it's been so choppy, but I guess maybe in a few months we can look at it as sort of base building. And it's had some comfort with improvement, or, a positive action in credit spreads and in the yield curve. So then it also, the rebounds out of the hit had comfort with the changes in credit spreads. So, with industrial commodities, but they reached highs and have been weakening a bit. The really big flyer in industrial commodities was lumber, and it soared huge, over 500, and that became very overdone. It gave upside exhaustions plus sequential sells, and has started what I think, it's had a very good correction, and it started what could be a cyclical bear market, because it was certainly a cyclical bull. It went from, I think, 240 up to, let's use the number, 540, almost doubled in a few years' time, which was outstanding. So, speculative excesses reached, corrections underway. Some of them, like in the Bitcoin side, are more like a bear market, where they maybe gave up huge amounts of the gain. And we'll just see how this all settles out over the next few weeks.
We'll have more with Bob Hoye right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, how do you expect gold to perform over the next few weeks?
Yeah, it's not doing what the gold bugs had expected. I think gold bugs all learned their stuff in the 1970s, where the Fed central bank recklessness went into inflation in commodity prices, wages, and gold, and all the things of inflation. And that then began to change, because you had a huge peak in commodities in 1980. And with that, the price of gold and silver. And then once they cracked, like in 1920, which was even a bigger boom in commodities, it sets up then what people have called the new financial era, where the action shifts over to inflation in financial assets, which has been the game since. But you did have that terrific bull market in precious metals right out to 2011 when the speculation became measurably overdone or way overdone. So in the big sweep on gold, you have had the action has been in financial assets, not in gold and silver, and we all know that because it's been very painful on the way down. But if you take gold's real price, which we do deflated by the CPI, that had the peak with all of the stocks and everything else in 2011 and came down to 2016, and we think it's base building. Now, every great financial mania in history, going back to the South Sea bubble in 1720, the action with that was that the real price of gold went down during the bubble, and gold stocks didn't perform so well. And this has been the case. The real price has come down, and then it's trying to stabilize, and I think it's stabilizing as the financial bubbles have blown out. Like a couple of years ago was the absolute high in bond prices, in the long-dated treasuries. More recently, the big speculative high was in junk bonds. So, and then probably the equity side of the market is completing its bubble. So against this, gold's real price has been building a base, and then what has happened at the end of previous bubbles, once we roll over and the contraction starts, then gold's real price has gone up very nicely for a number of years. And as the real price goes up, it's a proxy for improving profit margins for the industry. Because if you're getting a better price for your gold relative to your costs, hey, you're making money. So, but the problem in the meantime, gold stocks are vulnerable to what's going on in the big market with the New York Stock Exchange, and say we're looking for after mid-year that the big senior stock indexes could head down, and you're not going to have gold stocks going up when there's downward pressures on most of the stock market. But what is happening, Jim, is for the precious metal sector, it's getting set up for its bull market when the other sectors in the stock markets and in bond markets are not doing so well. It's not our imagination that comes up with this. It's that when you review gold's history for 300 years, since the first bubble started in 1720, then the history tells you something about it, and this is what we're looking at. So the other thing on the near term for gold, of course, is the action in the U.S. dollar, and it a month ago came down very hard, and that set up our buy. We got downside capitulations and a sequential buy on the U.S. dollar index, the DX, and it's been recovering and correcting, and but it looks like it's getting ready for a more extended rally, and that's not going to be happy for the precious metals. But the other thing is one of the features of life in a post-bubble contraction is that the senior currency, which used to be sterling and it's now the U.S. dollar, gets chronically strong against most other currencies and most commodities. So now it's a modest rise in the U.S. dollar, but after mid-year it could become a bigger rise, and that's going to put a lot of people offside. And by the way, this is the other thing is with the credit markets, like the curve and the spreads, after mid-year can take a turn to adversity, and the importance of those that change there is that there's a lot of players highly leveraged for the trend that's been on with the boom, and then when you get the change in spreads in the curve, all of a sudden some key players who are highly leveraged are offside, and then that starts to dislocate the markets. And like Bear Stearns in May of 2007, the yield curve started to change, and then followed by a few weeks later with the credit spreads widening, so that by the time you got to the end of May, that reversal had happened, and it was the first week in June when the bad news came out about Bear Stearns being totally offside. Again, you have, like, going back to 1998 when the big hedge fund, long-term capital management, they were positioned for narrowing credit spreads. But it started to change in May, and they were hung out to dry. And at that time, I guess $4.5 billion, it was the biggest default by a hedge fund there was, and that disturbed the market. So we watch what we can, and the main thing is that near term for gold is not so good, but the longer term for gold mining will eventually be good.
We'll have more with Bob Hoye right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, in a rising interest rate market, do banks make more money, or do they start to see business turn away because people can't afford the interest?
Oh, yeah. We look at the Treasury bill rate in the senior economy, U.S. Treasury bills, and man, the 3 and 6 month bill have been going up, rising hugely, like maybe 35 basis points in a couple of months. So the 3 month bill's up to 1.78%. And that's a sign that people are demanding or borrowing money. So there's a demand for money, interest rates go up. So rising rates are a sign that the boom is on. So we watch the T-bill rate to see if it goes down, rolls over and heads down, because that's then a sign that speculative demand for money is beginning to diminish. So, but the street professionally worries about rising interest rates, and it's the wrong thing. So long as rates are going up at this stage of the economy, it's a sign that the boom is still on. One wants to worry about when they go down. And as I said, the other way of looking at it is through the credit spreads, which is the difference between high-grade bonds and low-grade bonds. And then the other is the yield curve, which is the difference between long-dated instruments and short-dated in treasuries, for example. So we're watching these for change, and rest easy. So long as the T-bill rate is going up, the boom is on, and one wants to worry when it starts coming down.
Bob, thank you so much for chatting with us.
Yeah, Jim, it's good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or for the show, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.